Hello and welcome to another episode of Darwin Investors. All right, so we had a pretty good day today in the market, and who knows what tomorrow brings, but I'll tell you what I'm got in store for tomorrow should we have a little bear market rally if the CPI data doesn't come out. It comes out a little bit better than we thought it would come out. But I have noticed that here recently we've had quite a bit of like panic in the markets, and I'm not sure that it's all retail investors. I think it's a lot of hedge funds that are panicking. I think a lot of us retail investors, we're down this year. Like I'm down tens of thousands of dollars this year. You're not going to see me selling out of my positions, but these hedge funds aren't playing with their own money. Maybe they're the ones selling out of their positions. I saw it like yesterday, they were like selling out of all the energy and the commodities, cashing in on those things. That's what was happening yesterday, in my opinion. Those guys were trying to get some money back because when you're going to sell, you don't want to sell your down positions, you're going to sell your up positions. And in all this selling, it has created some deals out there. And so that's actually pretty good for us right now. It's a unique situation that you can actually exit some of your bad positions and get into better good positions that are down also. It's not like you're going to exit some position like a Unity software and go get into some other stock like it. You can get into a high quality stock like a Microsoft or something like that, and something you're really confident that's going to go up in time, because that's one thing that we have as retail investors as one of our assets is we have time. All we got to do is be patient, sell some covered calls on your equities while we're down. Stocks like Microsoft will come back. You should never bet against Microsoft. There are a lot of stocks that are way down right now. And so these are stocks that we could be getting into. So this is a good time to exit bad positions and get into better ones. And I'll show you some examples here in just a second. And then tomorrow is the CPI data release. The CPI last month came out at 8.5%. That was the inflation number, and tomorrow is expected to be 8.1%. I'm thinking if we get something south of, say, 8, it's going to really bounce tomorrow. Or even if we hit like 8.0, it's really going to bounce tomorrow. So I'll show you how I'm going to play that. And then finally, just like for a throw-in topic, I'm going to talk about some mistakes that the Fed has made, and these have been highlighted by a couple of billionaires here, David Tepper and Paul Tudor Jones. And I don't think that either one of them are wrong. Tudor Jones came out last week, and it was pretty controversial stuff, but I don't think that they were wrong. So let me go ahead and share my screen, and we'll get right into this. All right, so Unity Software came out with earnings today, and you can see that it's down here after hours 29%. And that's because it doesn't have a price to earnings ratio. And there are other stocks that are way down like that, like Peloton was way down here, like in the last 5 days, it's down 30%. And stuff like Trade Desk reported earnings today, it's down 8% after hours. And in the last 5 days, it's down 27%. And see, this would be one that has a price to earnings ratio. Its forward price to earnings ratio is about 70, but it's really highly valued. So these are the stocks that are getting beat up right now. And if you're in Trade Desk, there are ways out. Here's another one here, SoFi. SoFi has no price to earnings ratio. It's a popular retail stock. These are positions that maybe you could consider exiting those and getting into something else. And there's a lot of stocks out there that are badly beaten down that if you watch television, they'll tell you that they're not beaten down. I know how many times in the last week I had to hear them tell me that mega cap tech is what's holding up the stock market, and that's ludicrous. The S&P 500 is down 16.59% here year to date. If we look at some of these stocks here, you've got Microsoft down 19. Tell me how something that's down 19% is holding something up that's down 16%. Doesn't make any sense. Google is down 21%. Amazon's down 36%. Netflix is down 70%. Nvidia is down 41%. AMD is down 41%. Tell me how these things are holding up the S&P 500. They're not. It's insanity. Qualcomm is down 20. What are they down here year to date? About 26%. The only one that's kind of holding up the S&P would be Apple, and even it's close. It's at 15% down. So what's really holding up the S&P 500? Well, the stocks that are really holding up the S&P 500 are your consumer staples here. So I'm going to go through some of the spider ETFs, and you can see how much they're up. The staples ETF is up 9.39%. The energy ETF is up 46%. The healthcare ETF, the XLV, is up 4.22%. The utilities ETF, they're up 10.02%. So these are the companies that are really holding up the S&P 500. It's not big cap tech as television would have you believe. And I'm not a financial advisor, but if I was going to get out of a stock, let's say I had Trade Desk and I'm trying to get out of something like that and go into something else, I wouldn't be getting out of Trade Desk and going into something that's been high flying like a Procter and Gamble, like nothing within this 10% of its all-time highs, like a Procter and Gamble or a Johnson and Johnson, or anything that's been flying like those fertilizer stocks like Mosaic or CF Industries. Probably wouldn't go into any of the minerals and mining stocks, wouldn't go into like ConocoPhillips or Exxon or anything like that. I would go into something that's getting the living crap beat out of it, like Disney or something else. Like Disney is probably, what is SoFi down year to date? It's down 66%. What is Disney down right now? Probably about the same, So would you rather be in SoFi or would you rather be in Disney? Disney's down 31%, $107. So these are places where you could put your money, because remember, we have time on our side, we have patience, we have covered calls, and the best time to invest is now and has always been 20 years ago. And where do you think Walt Disney will be in 20 years? It's going to be doing pretty well. We're not so sure though about Trade Desk or SoFi, but we could be pretty sure that Disneyland will be around in 20 years. So what about tomorrow's CPI release? So I'm going here to the Bureau of Labor and Statistics. We can see that that here on May 11th at 8:30 a.m., the CPI data is going to come out. And last month, we were looking at 8.5% right here. That was what everything was up. It looks like most of it was here in the energy sector. You can see that energy and commodities were up 18, gasoline was up 18, fuel and oil up 22. You can see that year over year was up significantly, 32%, 48, 70%. We could see that last month some things did start coming down, such as say like apparel, like buying clothes was coming down. We could see that used cars and trucks and stuff were coming down. They're down negative 3.8 year over year. And so what we're looking for tomorrow is we're hoping that it comes in lower than 8.5. So April CPI estimate will be announced Wednesday before the stock markets open. Expectations are for the all items rate to drop from 8.5% to 8.1%. To hit 8.1%, it will have to be no more than 1.25% in April. And so I'm thinking that if we can get this a little bit lower than 8.1%, say 8.0, or what actually would be really good would be 7.9%, we would get quite a bear market rally. And what I mean by that is I think we would get quite a bump in the stock market tomorrow. And it's like 7.9%, that's way better than expected. And then the next day they're going to go, wait a minute, it's still 7.9%. And like stuff will sink in and then everything will crash. But in the meantime, I will go in, I will sell covered calls on all my positions tomorrow. And then I'll buy them all back the next day and try and make a little bit of money while the market realizes what it's done. And last here, I'm going to talk about this guy, David Tepper. And I think this is interesting here. Now, this is a billionaire and he's a big investor. And this morning, I'm not a member of the Kramer Investing Club, but what he talked about this morning was that he's covered his NASDAQ short and thinks the selling could be ending. And to me, this is kind of a tell. I mean, here's a billionaire, and he likes to go out on television. He's going to go tell you what he's doing because he wants you to follow suit. So here's a guy that's been selling the triple Q short, for however many months, and now he's coming out and saying, I'm going to start buying now. And I think that a lot of people are going to start buying a lot of these tech stocks. I mean, look at how far they're down. Look at how much money Microsoft makes and how good of a company Google is. Google is trading at half the price of Costco, and yet it grows at what? 20 times the rate of Costco. So, and it just bought back $70 billion in shares. It's the second biggest. Apple bought back $90 billion in shares last quarter, and Google bought back $70 billion. So these companies buy back their shares, they make lots of money, they have huge margins, and they grow big. And so that's the reason why guys like him want to get back into them right now, because those are the next ones that are probably, I think, that are going to go up eventually. Next, there's this Paul Tudor Jones, and he comes out and he says he can't think of a worse financial environment to buy stocks or bonds right now. And there's some merit to this, I think, because it's unusual for us to be going into a recession and what feels like one anyway, and the stock market is already tanking. And usually when the stock market's going down in the economy and we have demand destruction and you've got problems in the larger economy, you don't then tighten. You don't then start unwinding your balance sheet and stuff like that. This is when you want to try and stimulate things and get things going again. But there's some evidence out there that inflation may be on the decline. And though inflation is on the decline, there are more homes, just come out here recently, that there's more homes supply out there than what we're used to. And things seem to be not going that well, at the moment, economically speaking, and yet we're now tightening and raising interest rates, and so this is not a good time to raise interest rates. I'll show you what would be an example of a good time to raise interest rates. So what you want to do, I would imagine, is that when things are right after this big crash here, things were cruising along here at about 0% interest rates, and now things were still going really well. So here's where you raise interest rates. It's you got low unemployment, the economy is going well. Let's raise the interest rates, right? And then so get them up there while the times are good. And that's when you raise interest rates. You don't raise interest rates when things are going badly. You don't get here in the middle of this recession here and then start raising interest rates all at the same time. This would have been going into the housing bubble. This is the Fed trying to raise interest rates to slow the people buying houses. They thought things were getting out of control. The Fed could see this, and they were raising interest rates, and the housing bubble burst. And then right here is where we had the Great Recession, when Bear Stearns and Lehman Brothers went out of business after the housing bubble burst. And then it was zero for a while until things were good, and then they started to come up again. And then so right now we're starting. We're tightening just a little too quickly. I think that we should probably let this play out a little bit, but we'll see what happens. All right, so yeah, investing really is easy. You won't see me talking too much about the stocks that I own. I don't really worry about them. I mean, I've got my portfolio is basically NVIDIA, Microsoft, JP Morgan, Google, Amazon, AMD, UPS. These are all stocks that honestly, I just don't worry about them. And if you're in stocks that keep you up at night, or stocks that you do worry about, go into something else that is also beaten down, that you would have more confidence in. For me, Google it's the best stock in the market, and that would probably be the first place that I would personally look if I was going to build a position. It'd be the first stock I'd buy and the last one I'd sell. And then things like Amazon are good. I know that e-commerce, they talk about e-commerce is dead. Oh, sell Etsy, sell Wayfair. Like we're ever going to go back to stores again? Really? No, we're going to continue using e-commerce because we like stuff delivered. But anyway, so don't panic. Rotate into stuff that you like, and if we get a bear market bounce tomorrow, let's go ahead and what I'm going to do anyway is I'm going to attack it with some covered calls. All right, if you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Bye.